how volatility impacts option skew.
So certain assets tend to have call or put skew depending on the perceived directional risk in the market. I know TP mentions this in the cherry picks or the cherry bomb every morning. The velocity of risk. This is what we're talking about. It's a skew in the market, in the options market. Market ETFs such as SPY tend to have put skew because there's more fear to the downside, raising put premiums. The velocity of risk, the big moves, are typically to the downside. Some equities like a Tesla or a Palantir, you'll see upside skew because the moves are typically bigger to the upside than the downside. So what we're going to look at is how does put or call skew change as investors perceive more risk in the market? And we're going to be looking at SPY to do this. So we got a nice little SPY study here on the next slide. So we're going to be looking at the SPY and the VIX, and we're going 2015 to 2025. We're looking at 45 days till expiration, 16 delta puts and calls as standard deviation, our cookie cutter entry here. We're going to plot the average prices of the call and put options per 100 shares of the stock or the ETF here for each of the following IV index ranges. And so we're looking at 10 to 15, 15 to 20, 20 to 25, all the way up to 40 to 50. And so the IV index is our 30-day implied volatility index for each underlying. You can get this on the right side of the platform if you look under the quote detail.
In parentheses, right?
Yeah, well, so there's a bunch of different volatilities. This one is a VIX style implied volatility for each underlying. So it looks around 30-day implied volatility. It's simple for SPY because SPY and the VIX are that's basically what you're measuring. But if
VIX is the implied volatility of SPY.
Of SPX.
Yes, and
SPY,
SPX.
Yes. Mm-hmm. So this is intuitive. I mean, they're going to move hand in hand. But if you're looking for other underlyings, we plot it out as well for other underlyings so you can see, a VIX style implied volatility for those. Mm-hmm. So looking at the study, for skewed underlyings such as SPY, puts are consistently more expensive than calls. This is typical. You see this at pretty much all times here, roughly twice as much. As implied volatility increases, both calls and puts are worth more as a percentage of the underlying. This is important to understand because a lot of people think of volatility as being kind of a one-sided thing. When you have downside moves, volatility increases. You're seeing value on both the up and downside increase with pops and volatility.
Now this is now you used a good word. Well, they used a good wording. I want to make sure that as a percentage.
As a percentage.
Right. That doesn't mean the calls are actually going up. The calls could actually go down. They could go up too.
Yes.
Or they could stay the same on a percentage basis. They're more expensive.
And that's because you're typically dealing with a lower price.
You're coming from a lower implied volatility, lower price, yes.
Yeah, but the asset itself is lower. So the calls, all else being equal, are going to be cheaper as well. That's why a call on a $1,000 stock is going to be more expensive than one on a $100 stock, just because the actual stock price is lower. And so you could see 3 to 4 times as much for that protection. When you get pops and volatility, this is, very intuitive. When volatility increases, it's more expensive to buy protection.
Yes, yes.
So when we jump to the next slide here, you'll also notice that put prices increase at a faster rate than call prices. And this is, of course, intuitive as well. When fear, when there's blood in the streets, you keep more fear, those options become more expensive. So therefore, while put premiums are typically higher than call premiums for this underlying, they are even richer when IV is higher and there is more perceived risk. So even though you typically see the increase in volatility happen into the down move, so you have that realized volatility, the premiums as a percentage of the underlying also increase.
Puts or schmutz. That's where this comes from. That's where it is.
It just tells you that it's hard to, the main takeaway is that when volatility increases, the move has already happened. It's hard to hedge after the move has happened because things get way more expensive. This
is why we always talk about, hedging is just so hard on a position after the fact. And that's why you have to set your hedge, which is really your position sizing, on entry, not after the fact of when something is happening.
Yes. I mean, it all comes down to staying small, defining the risk on entry, if that's something you want to do, buying the wing, like we talked about with Jim. Those are ways to get synthetically long volatility. Like when you buy that wing, that 5 delta wing into a pop in volatility and into a down move, that option might go to a 10 delta or 15 delta. And that's hedging your position,
Yes,
before
but it's mitigating the risk on entry by buying buying that wing. I mean, synonymous to the same thing. Yeah.
Yes.
Yep. You got it. Good job.
Next slide, please. So according to this example, higher IV tends to exacerbate put skew. So obviously when you have higher volatility, you're going to see those puts especially the value of the puts be further down on the curve. So this means that short premium traders are further compensated for directional risk to the downside in this case when markets are more volatile and have more perceived risk, particularly directional market risk is higher. So when volatility expands, this is why we look for high volatility, right? Is because you're getting paid more to take that risk to the downside. You can go further out of the money on those positions.
Yeah, it's pretty, it was a simple-ish study on implied volatility and option skew, but this is why people will look who are leaning bullish and market typically goes higher, more percentage of the time than it goes lower. And it's almost like a gift to be selling puts into this because you get paid so much more.
But it's hard.
It's very hard.
It's always, everybody.
It's very hard, but it's been very fruitful. I mean, easy things are never usually
size. It always comes down to size.
The most fruitful.
You don't have to load the boat every time.
No, you do not.
Load the flotola.
That's correct. That's correct.
The great Sosnoff.
You are right. You are right.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.